Ladies and gentlemen, welcome back. This is Christopher Aaron. It is June 25th, 2020. I would like to do something a little bit different this week, and that is to create a video that looks at what the potentials are for both the gold market and the U.S. stock market over the decade ahead. And the point of this video is to do so in a data-driven way by looking at the actual numbers, the actual history of what we have in the relationship between gold and the stock market. And this video is one that I hope you will share with your friends and your family members who are not yet interested in gold. Because I really think this is one that even those investors who are just approaching this for the first time, or maybe they've never considered gold before, or they would have laughed at it before. You know who I'm talking about. I think this is a video that might make them think. And if they can begin to think about this, I think it is going to protect them over the years ahead if they can take some action over the intermediate term time frame here. No one needs to panic. No one needs to run out and buy gold tomorrow. But some prudent action when you look at the actual data here is going to be important. So please share this video with your friends and family members who are not yet thinking about it. And we are going to look at gold and the possibility of a stock market crash. This is something that most people do not think is possible at this point. But when we look at the data, it is showing us strongly that there is the potential for a significant drawdown in the U.S. and the world stock market, and that gold should be acting as a safe haven over the next several years ahead. I want to remind you to hit the subscribe button and the little bell icon so you will get notified when we release these new free videos. And if you're new to this channel, if someone has shared this video with you, I want to remind you that I do not sell gold. I do not sell silver. I do not sell stocks. I'm not a stockbroker. I am an independent analyst. What I do is I publish research. If you find value in that research, then some people subscribe to the other forms of research that we publish. If you don't find value in the research, then you look somewhere else for your analysis. That's all I do. So just telling you there's no conflict of interest here with me talking about gold and then trying to sell you gold, for example. No, this is all data. So what is the data that I want to talk about? It is this signal, which is the first such signal that we have seen in the last decade. Now, every chart that we look at here, for the most part, when we're annotating these, is going to have a key. So I'm bringing up this key here now if you're new to looking at these charts. The colors here that you see have a meaning. So let me tell you what we're looking at here for one moment. This is the Dow-to-gold ratio. It's a ratio between the Dow Jones Industrial Average, in other words, the U.S. stock market, and the price of gold. And we're looking back for the last 10 years. So what are the major things that we can see about this chart? For example, you look at the from 2011, the bottom here in this ratio at 6. In other words, it cost 6 ounces of gold to buy one share in every company in the Dow Jones Industrial Average. That is the figure from 2011. And we can see that there was a rising trend, right? 2 steps forward, 1 step back. 3 steps forward, 1 step back. 2 steps forward, 1 step back. A rising trend. In other words, the Dow Jones was gaining value relative to gold all the way through the peak here in 2018, but really the trend stayed valid until just a few months ago, right here in early 2020. The trend, which is defined by the lower boundary, you can see the hits on this lower boundary, the turquoise, which is now being called the broken trend. You can see that that lasted here from 2011 until the beginning of 2020. Stocks were gaining value relative to gold for almost a decade. But something has changed. Something quite dramatic has changed, and you can see it on this chart. So look at where my mouse is right here, this channel breakdown. You can see how this channel was broken lower. In other words, the Dow lost a significant amount of value versus gold right here, and I want to emphasize that with a big red arrow so you can see exactly what I'm talking about. In this breakdown, the Dow fell from 18 down to 11 ounces of gold in just a few weeks here. So this was on the panic of the coronavirus. Now, a 9 to 10 year trend here was impulsively broken lower, and then we've seen something of a recovery. So the type of analysis that we do here, which is based on technicals, which is based on price, analyzing price, is showing us that the recovery that we've seen in the Dow Jones here over the last 3 months is nothing but the first bear market rally in a new trend which is developing of lower and lower values for this ratio. When you have a 10-year trend, almost a 10-year trend here, that was impulsively broken to the downside, it would be very rare for that new trend moving lower to be done in just 3 or 4 months. Typically, when we have almost a decade of a trend in one direction, the new trend which begins to develop will last for several years, if not an equal amount of time as the previous trend. So there is a reason why I was more cautious on gold here over the last couple of years, is because we had not seen this data point now. This data point is showing us that the Dow Jones is set to lose significant value further over the years ahead when we compare it with gold. That's what the data is showing us. You can say, if you're new to the gold market, you can say, I don't understand gold, or why would anyone ever invest in gold? It's just a rock. It just sits there. That's fine. You're entitled to your opinion. But the data is showing you here that the market, the sum of the participants in both the Dow and the gold, the sum of the participants are strongly disagreeing with you. And if you disagree with the actual market, at certain times, you can do so at your own peril. And that's what this type of analysis is showing here. So I think this is an important time to begin learning about the gold market if you're only approaching it for the first time. This is not a recommendation to take all your money and put it into gold. This is not a recommendation to take the money that you are going to allocate to gold and do it all in one moment. No. You want to use a bit more prudence, a bit more caution, come up with a strategy that allows you to enter this market in an appropriate way over time and in appropriate forms. But the trend is now strongly moving in favor of gold, and this should be lasting well into the 2020s. We have a previous data point here back in 2011, as I said, of a 6-to-1 ratio. And right now, this ratio has closed at 14.5. So you might be saying, well, okay, so what is the potential here for this ratio? What could we be looking at for this if this goes on into the 2020s? So let's back this all the way up and look at this same Dow-to-gold ratio now going back for 100 years. And for reference, we were just looking at this little box right here. We're talking about the decisive breakdown in that trend, and now there should be starting a new trend moving lower. And look at some of the other times when there's been a new trend moving lower in favor of gold. This tends to carry on for some years, right? If not a decade. And so we're saying, what is the potential here for this ratio? Let's bring up, what is this that we see along the bottom? This is a multi-decade support zone for the ratio, for this Dow-to-gold ratio. Again, we're just talking about how many ounces of gold does it take to buy one share in every company in the Dow Jones Industrial Average. And so when the ratio is higher, this means that the Dow is worth much more than gold. And when the ratio is lower, it's telling us that gold is gaining in value relative to the Dow. And so here we are, and we can notice that this ratio throughout 100 years has bottomed repeatedly in this zone between 1 to 3. We can see the number of times here: 1976, 1980, 1946, 1933. The number of times here that this ratio has bottomed between 1 and 3. And we now have a new trend working lower again over the years to come. And so our working hypothesis here, our working model for how we are allocating capital, is that we should remain bullish on gold until we begin to approach this multi-decade support zone again over the next 10 years. And so let's look at some probabilities, some actual figures of how this could work out based on those previous data points of the Dow to gold ratio. And we will look at 3 periods. We will look at the present, where I said that ratio is now 14.5 to 1. We will look at the 2011 bottom in the ratio when the Dow to gold hit 6 to 1. Remember, this is when gold hit 1900 per ounce here in the United States. And then we will look at the 1933 and the 1980 bottoms when that Dow to gold ratio hit that 1 to 1 figure. We just looked at that on the previous chart. For that matter, we will look at 2 separate scenarios for these. We will look at deflationary scenarios where we were talking about things losing value relative to money. And then we will talk about inflationary outcomes where money loses value relative to things because of the debasement of currency and the printing of money to bail out banks or to bail out institutions from the coronavirus or what have you. So let's look at this. Where are we right now? The Dow is at 25,700 closing today, and gold is at $1,770 per ounce. That is a 14.5 to 1 ratio. This is where we are today. Let us imagine if that figure that we just saw in 2011 in the last slide, that 6 to 1 ratio, let's imagine if that is hit again by the Dow losing half of its value. So falling from 25.7 down to 12.850. What would this mean for the price of gold? At a 6 to 1 ratio, this would mean gold hitting $2,141 per ounce. This gets us to that 6 to 1 ratio. And so you're saying, oh, that's impossible. You know, the Dow, there's no way the Dow is going to fall 50% from here, right? They'll never let that happen. The government or the Fed will step in. Okay, maybe you're right. So maybe it's an inflationary outcome. Maybe the Dow doesn't change at all and stays exactly where it is right now. But we just saw in the last slide that ratio in the Dow to gold is now strongly moving lower, in favor of gold. So you can't argue with the ratio. You could argue with me that maybe the Fed or the government steps in and they don't allow the Dow to collapse 50%. Fine, but that ratio is still moving lower. So in that case, we are going to be looking at a gold price hitting $4,283 per ounce. Both of these data sets here get us to that 6 to 1 ratio. And the question is, in either of these scenarios, which asset class do you want to be owning? The argument here is gold, because even if the Dow maintains its value, if this ratio compresses lower in favor of gold, you're going to have gold prices almost tripling from where they are right now. Would you rather have a triple over the next decade or be sitting on something that's stagnant? Now, in either one of these scenarios, the important takeaway for stock investors, for Dow Jones investors, is that this ratio moving lower signifies in real terms a 59% crash in stocks. Either way, from the present where we are now, if you take the Dow falling by 50% and gold gaining here slightly, that is a 59% crash in the real value in stocks. Similarly, if the Dow does not change at all, but gold rises to this figure here, it is the same difference. How do we know that? Because the ratio is the same. We're talking real value. We're talking how many stocks can you buy for your gold. Either way, according to this analysis, you will be better off in gold over the years ahead. Now, this is that previous 2011 bottom that we're talking about here. Let's talk about the 1933 and the 1980 bottoms, in which both of these times, we're going back, 1933, this is right in the middle of the Great Depression, when the Dow Jones had fallen by 90%. And then what happened? Roosevelt outlawed the private ownership of gold and then revalued it upward by 75%. Both of these figures, got the Dow and the gold, approached 40. Gold was revalued to 35 and the Dow Jones fell to 42. It was roughly 1-to-1. And in 1980, the Dow hit 850 while gold was worth 850 per ounce. So this has happened twice in history. And so if we look at the potentials here, let's imagine the outright collapse scenario here for the Dow Jones. Imagine that the Dow falls by 90%, right? What happened in 1929. Imagine a 90% crash in the Dow. What would this mean for gold if we were going to reach that 1-to-1 ratio? It would mean gold moving to 2,570. In other words, they're the same, 1-to-1. Remember, this has happened before twice in history, and we've just seen that ratio breaking lower. This is not pie in the sky imagination here. What if they prevent the Dow from falling and they keep it propped up where it is, but this ratio still bottoms at those former levels? Well, of course, we will be talking about a gold price matching the Dow. And you say, this is impossible, 25,700 matching the Dow. This happened twice before in history. That's what I'm saying. It has happened before. It can happen again. And the data is showing us that it's going to be moving in that direction once again. The bigger takeaway, of course, for stock investors, I'm trying to speak here to mainstream stock investors, is that either one of these scenarios represents a 93% crash in the real value in stocks. If you have that 90% crash in the Dow and a slight revaluation higher in gold, it does it that way. And it also does it if stocks don't move and you have gold moving up over 15-fold. And so once again, I know we're getting into a lot of hypotheticals here, and it's easy to get lost in the numbers sometimes, so I just want to bring back the chart up again. We're not making this stuff up. We see a 10-year channel in which the Dow was outpacing gold here, decisively broken to the downside and now getting rejected again by this former support level. Boom, rejection just a couple weeks ago. When we look at the 100-year history of this, and we look at that breakdown that's happening now, this ratio tends to not bottom here at the 14.5 level. Once it starts moving lower, it tends to bottom in the 1 to 3 range, and we had a short-term bottom here at 6. Even if it only gets to 6 this time, this is going to be a significant revaluation higher for gold over the years ahead, and or a significant decline in stocks over the years ahead. And so I want to encourage you to genuinely think about the data that we have presented here today. Once again, I have no gold to sell you. What I am doing here is presenting research and analysis. This is how we are investing here at my firm, iGold Advisor. And this is how we are investing for a number of our clients as well. If you would like to be one of our clients and learn the exact moves that we are making here and the exact research that goes into those moves, know that we have a service available for you, which is called Precious Metals Intelligence. In this service, we produce videos just like you have seen today, except they are much longer than what you have seen, and they come out once per week, every single week, for 50 weeks out of the year. Not only do we cover the Dow and gold, we cover silver, we cover the US dollar, we cover other commodities as well. We also cover the gold and silver mining sector, which if you're new to this space entirely, just know that the gold and silver miners are like buying gold on leverage. They move significantly higher and significantly lower depending on what the price of gold is doing. And so there are ways to make small or large fortunes with relatively small moves in the underlying metal. We give you the exact buy and sell signals that we are using here. All of this is included in the one service called Precious Metals Intelligence. If you like the type of analysis you're seeing now, and if you are committing or thinking about committing a significant sum of capital to the precious metals markets, you owe it to yourself to check this out. If you would like to speak one-on-one to myself, Christopher Aaron, once again, I take no fees or funds from any of the dealerships or any of the gold mining companies that we talk about, any of the silver companies. I simply work for the best interests of clients, individuals like you. We have people from entirely across the spectrum, those who are just beginning, who have never bought gold before in their life, to those who are looking to diversify multi-million-dollar portfolios, and their precious metals exposure will only represent a fraction of that. We understand all of that, and we sit down and we come up with a game plan together using high probability data. This is what the data shows us. You just see in the video here. We try in this service to stay away from, just releasing hyperbole and statements like, well, gold's going to $10,000 per ounce, next year. We try to stay away from that. We try to look at what the markets are actually showing us. Now, some people have asked me, well, Christopher, what's your take on what the Dow-to-gold ratio is going to eventually reach? Is it going to be that inflationary outcome where we see gold go to $25,000 per ounce as the Dow stays where it is? Or is it going to be the deflationary outcome where we see stocks crash and we see gold only rise a little bit? I think it's going to be a combination of the two. I actually think the deflation is going to happen first, and then the inflation. And if you want to put me on the spot and ask, what do I think that final meeting of the Dow-to-gold ratio is going to be? I think it's going to meet somewhere in that 1 to 2 range. And I wouldn't be surprised if it's something like 8,000 on the Dow and 4,000 on the price of gold. Or if it's going to be a 1-to-1, it may be 8,000 Dow and 8,000 gold. Somewhere in that range is going to be where this market ultimately moves to, at which point it will be time to start scaling out of your gold. That will be right at the peak of the mania when CNBC and Fox and all the other markets, all the other channels out there are running advertisements for gold and have special hour-long programs devoted to buying gold, or the latest gold miner is floating an IPO and their shares shoot up 100% the first day that they IPO. In that window is going to be when we start selling our gold and buying other assets. This should become something of a mania at the end. We are nowhere near that yet. Please use this time to think about it and to educate yourself, and know that we are here to assist along the way. Guys, once again, share this video. Share this with your loved ones who you think would laugh at you for talking about investing in gold. Sometimes we make these videos that go over the real fundamental data points in the gold market so that people who are just approaching this for the first time can actually see it with their own eyes. So share this with them. Get the word out. I genuinely am concerned about mainstream investors over the years ahead. The time to protect ourselves, the time to be worrying about your friends and your loved ones is not once the damage is done, it's right now. So thank you for tuning in, and I will see you this time next week.